Hi, I'm Benjamin Hawes of the Hawes Financial Group, where we align your personal values, vision, and wealth. Over the course of the last couple weeks, we have shared several proactive tax planning strategies that one might use in planning their financial future. Today, we will share an example of how one couple might implement these strategies based on their personal values, vision, and wealth. This is a hypothetical case and may not be suitable for all investors. There's a husband and wife, ages 64 and 62, who are recently retired. They have 2 adult children and 4 grandchildren and have downsized their home to move closer to their family. Their primary goals are to make sure their retirement income is secure, to reduce their income tax liability, and to prepare their estate, which they intend to leave primarily to their heirs, but also to a specific charity they regularly support. They're also concerned about future healthcare expenses. They have assessed that their pension and Social Security incomes are sufficient for their retirement needs. They also receive investment income and dividends that help cover their retirement wants and wishes from year to year. They have built a cash reserve, but also have the cash proceeds from downsizing their home, which they think of as their healthcare buffer. There is appreciated stock from her working days and IRAs that they are not currently taking money from. Finally, he has some old life insurance policies that they continue to pay for. With these goals in mind, here are a couple of proactive tax planning strategies that, when used together, might help this couple meet their short-term and long-term objectives. First, they might consider the Roth conversion strategy. They ask their financial planner to work with their tax accountant. Together, they determine the couple could convert $50,000 a year without moving into a higher tax bracket. The approximate tax liability for this conversion would be $12,500. Should they implement this strategy each year between now and their respective RMD ages, they could have in the neighborhood of $350,000 in Roth IRA assets, reducing their future RMDs and enjoying tax-free growth moving forward. Now, when considering a conversion strategy, it's important to note that the IRA account owner should consider the tax ramifications, age, and income restrictions in regards to executing a conversion from traditional to Roth IRA. The converted amount is generally subject to income taxation, as shown in this example. Second, they could consider transferring their corporate stock to a charitable remainder trust. Because the stock has appreciated over her working career, there is potential tax liability to selling it. So this strategy allows them to avoid capital gains tax, receive an approximate $125,000 tax deduction for their gift, while also entitling them to $15,000 of income back from the CRUT each year until she passes away. Ultimately, the remainder of the assets in the trust will go to the charity of choice, meeting another stated objective in their estate plan. Now note, this gift would afford the couple the ability to accelerate their plan to convert traditional IRA assets to a Roth IRA, because the charitable deduction could, in part, offset tax liability. Also, if they do not need the income from the CRUT in a given year, they could make gifts to, say, their grandchildren with the proceeds. Lastly, they could use the income for a life insurance policy, which is the next consideration. They could consider a strategy to consolidate their life insurances into a new policy with a higher death benefit. By consolidating these policies, he could apply for a $500,000 permanent death benefit that would require an $8,000 annual premium expense. This expense could be covered by the CRUT income or by the projected RMDs they will be forced to take in the next couple years. He could list his wife as $200,000 beneficiary and his children as $300,000, effectively replacing the stock they have now earmarked for charity by using the charitable trust. Now, when considering this strategy, it's important to examine your health, as they may affect the ability to take out a new policy as well as the premium cost. In summary, the combination of these strategies helped this couple meet their financial planning objectives, all while being proactive about their tax strategy. They moved assets to the right, generating tax-free income opportunities in the future. They received tax deductions for making their charitable gift. They repurposed life insurance to create a larger tax-free death benefit for their heirs. They structured their estate plan to include both their heirs and charity. And they removed assets from their estate, strategies that we will discuss in our next series. Now, as stated before, these strategies can be a bit complex and may require the services of multiple professionals to ensure that they've aligned finances, taxes, and estate plans. So be sure to speak with qualified professionals before implementing any of the strategies discussed.